We are now going to start our discussion on option pricing. Our goal is finally the Black-Scholes formula, which is a popular thing. It's a part of folklore of finance, and we are going to start from the very simplest model which is actually used in practice. It is called the binomial model or Cox-Ross-Rubinstein model, the CRR model, the people who first started this, and it gives you no arbitrage pricing. That the price that you would quote in the market would be free of arbitrage. So, price of what? The price of an option. We will come to all of them. So, here we start with the scenario where there is a market with one asset and you have also an access to money market, means risk free asset, means bank or something like that, where you can put money in fixed deposit. So, is the one market has one asset. So, it is a very idealized system. This is how models are built in finance, or models are built in physics. You take the most idealized system and try to build your model. Even in research, we also take the simplest situation and try to analyze it first, then going into much more complex situations. One asset and money market. This is the scenario we have. Money market means a bank, something like that, bank you can. So, this is the market that we are going to study. So, suppose asset means this asset is a risky asset, this is not a risk free asset, risk free asset is this one. Now, in this procedure we will just consider two periods, that we will invest money now and get some money at time period t equal to 0, we will invest some money and then get something at the end, right, at the period 1. So, let S0 be the price of that risky asset at time t equal to 0. So, you have paid S0 to buy this asset, and now t equal to 1, we assume that there will be only two possibilities, the price either goes up or price either goes down. Basically, you toss a coin, if it is head the price goes up, if it is tail the price goes down. So, which we write S1H and S1T. S1 is to denote the time period t equal to 1. We will just look at this period, the trading is only just for one period, it could be 1 month, 2 month, 1 hour, whatever, does not matter. Time period t equal to 0, time period t equal to 1, and we make a very, very simple assumption that u S1H can be is u of S0 and this is d of S0, where u is strictly bigger than d, right, means the price would increase. Basically, you should always have u bigger than 1 and d less than 1, that is the price either becomes more from S0 or it reduces from S0. Of course, if d is bigger than u, you can switch your coins, my head, you can call the head as tail, tail as head. So, this is the basic scenario, basic model. Now, because you have the money market, because you have access to a money market, you can borrow from the money market and you can put money in the money market. So, they offer you a risk free interest return, rate of return or interest rate. So, if you put 1 rupee at time 0, at time 1 you will get 1 plus r rupee, that is it. Now, what is an arbitrage? We have already spoken about arbitrage here as well as in the previous part of these lectures. The arbitrage is the way of making money without making any investment. That I can make 0 investment, put money in the market, and I will have a positive probability of positive probability of actually making money. So, that is something very important. So, arbitrage means zero investment plus 0 investment would imply positive probability Let me tell you how. Suppose I buy 10 pens for 30 rupees each, so I get 300 rupees. So I 300 rupees invest, I get 30 rupees. Then I come and sell those pens at 35 rupees each. So I have 300, I get 350 rupees. So I cover my investment 300 rupees and make 50 rupees extra. So I have made 50 rupees without actually investing anything. So that is called an arbitrage. Markets, this can routinely happen, but when an arbitrage starts occurring, the arbitrageurs will start their trading heavily, and that will be very importantly observed. Actually, a lot of people do arbitraging. They look at the BSE index and NSE index. They look at the price in stock at BSE and NSE. So they buy at one exchange, sell at another exchange, and make money. Just like the way I spoke to you about the pens. But the market will always very soon adjust, and both the prices in both the stock exchanges will become same. I have a real life experience of this. I was trying to buy things, buy a water bottle in a railway station. So they were asking 20 rupees for a cold bottle. So then I go and check with another one, he was asking for 15 rupees. So I came back to and the other one had a lot of crowd. So I came back to the older shop, and I told the people, oh, don't buy here, the other one is giving at 15 rupees. So everybody started to leave, and he said, no, okay, wait, please, I am giving you the things at 15 rupees. So the prices equalize. So the market doesn't allow arbitrage. So this is a very important rule of the market. So here we have U, D and R, three quantities given to us. What should be the relation among them, so that I will guarantee this fact that there will be no arbitrage. The relation between them of course is so this is my no arbitrage condition. We will say why. No arbitrage condition. Okay. So why should this be a no arbitrage thing? Let us look at it. So let us see whether if I don't follow this, whether we get this thing, whether arbitrage comes. Suppose D is strictly bigger than 1 plus R, then what would happen? So S0 into D or equal to, sorry, D is equal to, so S0 into D, so they should be greater than equal to, I am taking the converse, that this does not happen, greater than equal to happens. So what happens here? I can go to the bank and borrow a money at interest rate S. I can ask S naught amount of money. Taking that S naught amount of money, I go and buy that stock, buy that units. This is the price of one share. So I buy that one share at S0, and then when it comes, I sell it at either S0D or S0U. But suppose I sell it at S0, if S0U comes, so which means because U is strictly bigger than D, S0U is strictly bigger than S01 plus R. So here head can come with probability P and tail can come with probability Q, with P plus Q is obviously equal to 1. So I did not write, it could be half also, it just unmarked. So if S0D comes and if S0D comes, S1T comes and it is equal to S0 into 1 plus R, then I have no problem. I still can, so S0 into 1 plus R is the money I have to give back to the bank. So, if S0D is equal to S0 1 plus R, I get that S0D and give it to the bank. So, I had no loss. But if S0U comes, S0U is strictly greater than S0 1 plus R, I can still give back that money to the bank and get some profit. So, if S0U comes, S0U minus S0 1 plus R, this is the money I can make with probability P. Probability P, this is the money I can make. So, I have invested nothing and I am making money with a positive, I have a positive probability of making the money, making some money. So, if this happens, arbitrage happens. You can argue out this part. What would happen if this happens? Right. Now, here our job would be to find the price of a European call option. So, I will now explain to you what is an European call option. We had described in the part 1 of this course, but I will still do now for especially the newcomers. So, now we are going to talk about European call option. So, what is a European call option? In the European call option, in this simple setup, suppose I have a stock and I own that particular asset and I come to which I have bought with S0 amount of money or whatever, or I may not even have the stock, right. The idea is that I come in a contract with you, say, and say, okay, at time 1 I am ready to sell the stock at the price K, and where we would always assume, or it will make much more sense, so I sell the option to somebody, that is called a call option, that I am ready to sell the stock. When you are selling the stock, it is called a call option. When you are buying a stock, it is called a put option. So, I am ready to, I am coming to a contract which is called an option contract, that I am ready, seller of the option is ready to sell the stock to the buyer of the option at time t equal to 1 at the given fixed price, which is the agreed price K, which is also called the strike price. Now, the person who buys the option has the right to buy the stock at time 1 with the price K, but is under no obligation to buy the stock. So, buyer of the option has the right but not the obligation. So, suppose it is S1T is my final price, then I will buy it cheaper from the market. Why would I take it up from a higher price from you? But if it is at a higher price, then I, as the seller of the option, have to buy the thing from the market at the higher price and sell it to you at a lower price, incurring a loss of S1H minus K. So, that amount of loss will come to me. So, since I am exposed to risk while you are not exposed to risk, this contract involves a premium. Because I am exposed to risk, that I would have possibly have to sell you the stock at a much cheaper price, was because what you will do, you will buy the stock from me at a cheaper price and sell it at the higher price in the market and make that money, which I will be losing, because I can't do anything, because I am obligated now to sell you the stock. I am under obligation, but the person who is actually holding the option contract is not under obligation. I am the seller of the option, is under obligation. So, the value of the option at time 1, which let us write as V1, is the max of S1, I am not writing S1 minus K. So, I am just giving a dot here and 0. So, if it is heads V1H, then obviously the max is S1H minus K. But it is tail, it is 0, sorry, T, because if it is tail, that this is negative and this is 0. So, this value of the option, this is the worth of the option or the value of the option, not for the guy who has sold the option, but who is holding the contract. It is the value worth for him, it is the value of the option. We are supposed to find V0. V0 is the value of the option at time 0, and that is the price the option seller will ask from its buyer. So, what will I do with this money V0? So, that is called the option price. V0 is called the option price. So, what shall I do with this money? What is my intention? What am I supposed to do with this money? Right? I am supposed to now take this money and invest in the market. So, I can invest a part of this money in buying the stock, part of this money in put it in the bank. So, at the period time t equal to 1, the total asset, so I will create a portfolio, one with the stock, one with the fixed deposit and my risk free asset. So, at time t1, the total value of my portfolio should be exactly equal to the value of the option. So, whatever loss I would incur by selling you the option, if I have to sell, is hedged or taken care by the money that I will get by actually trading in the market with this option price. So, this process is called hedging the short position. Short position is when you are selling, when you are the seller of the option, that is the seller of the option. When you sell the stock, you are in short position. When you buy the stock, you are in long position. Hedging the short position. It is also called the method of replication. This hedging is a fundamental fact in a finance market. All these investment executives, investment bankers, investment gurus or blah blah stuff, their real job is to hedge the exposure to risk. So, if you are some guy who is trading in options, then you are exposed to that risk. Now, who sells and buys option? Options are not bought by ordinary people like us going to the market and they are buying options. Options are bought by very big companies. For example, airlines come into option contracts with oil companies because oil prices can fluctuate, right. So, they come into contracts with various oil companies, right. A particular state can come into option contracts with electricity companies, particular industry for example. There are cash rich speculators who can buy options, but an ordinary person shouldn't buy an option because in the real market 95% of options become worthless, they are not actually finally executed. Only 5% of options are executed. So, in general, option is a very tricky subject when you are just talking about ordinary investor. But for very big companies, very big organizations, option is a very valuable instrument, and it is called a derivative security. Option, this term option is called a derivative security. Derivative is not a derivative of calculus, but derivative security because the price of this option depends on the price of a security, the risky asset, right. So, that is why it is called derivative security. So, why then are we pricing options? What is the interest in pricing the options if I am ordinary investor is not going to really use it? But a huge amount of investment in the market is not just by the ordinary investor but by big organizations. So, essentially the option pricing not only brings out a very beautiful aspects of the mathematics required to actually price the option, but these techniques are very useful to very big organization. So, investment firms are very interested in doing this option pricing because then they get a lot of projects, a lot of money from the very big organizations. So, very big organization will ask an investment bank to buy and sell the options for them and do everything that is required. So, that is why option pricing is very important. But I would really tell that if you are thinking of going to the stock market and investing, never, if you are an ordinary guy like me, don't just invest in options, just do standard trading, selling and buying of stocks, that is all. Okay, so that is one aspect of it. Now let us see what we are supposed to do. So the market in which we can completely hedge our exposure to risk, if the seller of the option can completely hedge his or her exposure to risk, then such a market is called complete market. And the portfolio that we create with this money V0 is called a replicating portfolio. Basically, you are trying to replicate the option. So, right, this complete market is absolutely a fundamental notion when you are talking about European call option pricing using the Black-Scholes idea. But in real markets, there may not be complete, that you may not be able to replicate the portfolio or do a perfect hedging. This is called perfect hedging, that you are replicating portfolio, the worth of the replicating portfolio is exactly same as the worth of the option. So it is very important to note that we are going to study only in complete market. We are not going to make the study in incomplete market. Incomplete market is a completely different ball game, has completely different analysis. I cannot promise you whether I can give you some examples in the incomplete market also at the very end unless I complete this. If there is a time, I will do it. If there is no time, I beg forgiveness. But it is very important, those who start off with finance, to understand what we can do in a complete market. If we are in these idealistic situations, what we can do. So today we really have no time to do the complete analysis of how to get this option price, which we will take up tomorrow. In tomorrow's class, we will take up how to do this option pricing and how to get V0. So the worth of the option at time 0 is the price that you pay. This is something you put in your head. You have to put in your head that you are in a no arbitrage setting. You have to put in your head that the market is complete. You have to put in your head that you will always be able to get a replicating portfolio. So that is what makes a complete market. So here what about the put option? There is something called the put option. In a put option, what you do is very interesting. In a put option, you, instead of you being the seller of the stock, you are the buyer of the stock. So in that case, the scenario reverses. So if you come into a contract with me, then I am obligated to buy a stock from you at a given price K, right, at the given appointed time. So there is an expiry time for the option. So here in this case, our simple case, you enter the option contract at time t equal to 0 and time t equal to 1 is the expiry time of the contract. And the European call option has a very important feature. You can only exercise that European call at the expiry time of the contract. You cannot do it in the middle. American call options you can do it in the middle. We will not study American call options, it is pretty involved. For t equal to 1, if we say this is the expiry time, only at t equal to 1 you can actually, when we are discussing it, we are assuming that t equal to 1 is our expiry time, because there is no other possible time in our simple model. Okay. So, this exercise has to be only at the expiry time. You cannot exercise your right option at any other time. So, for a put option, what would happen if the price goes down? You will come to me and I have to sell you at a higher price. That is, I have to buy it at a price S1T instead of going to the market, right? You will now buy it at a lower price at S1T as an option holder, and you will come and I will be obligated to buy from you at a higher price, when I know that I could have bought it easily from the market at a lower price. So, I would be having a loss, right. So, this whole thing will change if you have a put option, right. This then V1T would become S1T minus K, right, sorry, K minus S1T. So, V1T would become K minus S1T, V1H would become 0. So, that is called a put option. So, there are some issues like put call parity, etc., which we are not going to bother now. So, tomorrow's job would be to see how to compute V0. So, our focus tomorrow would be to step by step compute V0 and then see what are the consequences associated with it. And once we do with one period, our next class we discuss the multi-period model, and once we do the multi-period model, we will go to the continuous time. Of course, one can show that why this binomial single period model is, or this multi-period model is important, because when the number of periods is sufficiently large, it can actually replicate what is happening in the market. Market can be modeled very well. So, binomial pricing techniques are heavily used in the market to very easily find the option price, because for n very large they tend to the Black-Scholes price. So, that is one of the reason that they are used in the market. So, of course, there are many softwares which exactly use the Black-Scholes price. So, after doing that, we will make you might feel it is slightly an arbitrary jump. Okay, we will make the arbitrary jump to a continuous price system, that okay, the trading is going on at very small intervals. Trading of course does not go on every second, it has little gaps, but from a theoretical point of view you can always consider it to be continuous. So, thank you very much for your attention. So, we will be going and trying to find the price V0 in the next class. Thank you.